So, you're thinking about starting a business with someone? Well, you've probably kicked around the idea of a partnership. It's one of the most common ways to get a new venture off the ground, and for good reason. It's an exciting path for sure, but it is also filled with some unique rules and, honestly, some pretty big risks that you absolutely have to understand before you dive in.
Okay, picture this. You've got it. That brilliant, game-changing idea. You can see it all so clearly in your head. The product, the branding, the happy customers. It's perfect. But there's just one little snag.
You realize that, as great as the idea is, you just can't pull it off by yourself. Maybe you need someone with skills you don't have, or you need more cash to get started, or, let's be real, you just need another brain in the game to share the workload. It's a classic problem every founder faces. And if you're feeling that way, trust me, you are not alone. Let's meet Sierra, a super talented landscape architect, and her friend Dale, who's a pro at hardscaping, patios, walkways, that kind of thing. They both realized that if they combined their talents, they could create something way bigger and better than either of them could do on their own. So they decide to form a partnership. This brings us to our first big question. Why would you even choose a partnership in the first place? What exactly is it, legally speaking? So, at its very core, a partnership is a legal business structure where two or more people get together as co-owners. Now, here's the really crucial part. The business itself becomes its own legal entity, separate from you and your partner. To get it started, partners will contribute stuff like cash, equipment, or just their valuable skills. But, and this is a big but, forming a partnership is not a decision you should make over a quick coffee. You really have to weigh the awesome advantages against some potentially serious risks. Let's break down the major trade-offs. Okay, so the advantages, they're pretty tempting. A huge one is how taxes work. The business itself doesn't get taxed. Instead, the profits and losses just flow through directly to the partner's personal tax returns. Plus, they're usually pretty easy and cheap to set up. But you gotta look at the other side of the coin. The disadvantages are serious. It can be tough to raise a lot of capital, and the partnership technically has a limited life, which means if one partner bails, the whole legal entity dissolves. Now, I want you to really focus in for a second, because there are two disadvantages on that list that are so incredibly important, they deserve their own spotlight. These are the risks that can have massive, and I mean massive, personal consequences if you're not ready for them. First up, unlimited liability. This is the big one. It means that if the business can't pay its bills, creditors can come after your personal assets. We're talking your house, your car, your savings account. And what's wild is that you are on the hook for all of the business debt, not just your half. This is probably the single biggest reason people choose other structures like an LLC, which are specifically designed to protect your personal stuff. And right on the heels of that is the second major risk, mutual agency. This basically means any partner can act as an agent for the business. They can go out and sign contracts that legally bind the entire partnership. So your partner could go sign some massive deal you know nothing about, and guess what? Because of unlimited liability, you would be personally responsible for it. You see how those two work together? It's a powerful and honestly a kind of scary combination. So you're probably thinking, okay, that sounds terrifying. How do I protect myself from all that? Well, the answer lies in creating a rock-solid foundation right from the very start, and that foundation is called the partnership agreement. I absolutely love this quote because it is so true. A business partnership is a massive financial and personal commitment. You are literally tying your future to someone else's decisions, their work ethic, their judgment. You wouldn't get married without talking through the big stuff, right? You shouldn't start a business that way either. Just think of the partnership agreement as your business prenup. This is where you hash out all the tough questions before they turn into huge problems. You've got to define everything, and I mean everything. Who's putting in what cash or equipment? How are you going to split the profits? Who has the final say on big decisions? And maybe most importantly, what's the exit plan? Having this all down in writing is your single best line of defense. Okay, so you've done the hard work. You've got your agreement, the business is up and running, but here's the thing about successful businesses. They almost never stand still. They grow, they change, and that often means bringing new people into the mix. Let's check back in with Ciara and Dale. Their business, Acorn Lawn and Hardscapes, is a huge success. Actually, it's too successful. They have more clients than they can handle, and they realize they need a new skill set, specifically someone who can install custom ponds. So they decide to bring in their friend Remy. But that begs the question, how you fairly bring a new person into a business that's already up and running and doing well? This is where accountants use a pretty clever idea called the bonus concept to keep everything fair. It can go one of two ways. First, you might have a bonus to the old partners. This happens if Remy has to pay a premium to join their already successful business. That extra cash is considered a bonus to Sarah and Dale. But it can also work the other way. It could be a bonus to the new partner. Let's say Remy's pond building skills are so valuable that Sarah and Dale offer him a bigger slice of the pie than his cash investment is technically worth. In that case, he's the one getting the bonus. It's really all about negotiating the value that each person brings to the table.
Now, this whole process of adding a new partner or having one leave brings us to the final stage in the life of a partnership, dissolution. And I know that word sounds super dramatic, doesn't it? But it doesn't always mean the business is failing.
A dissolution is really just the legal end of a specific partnership agreement. It gets triggered by any change in the ownership. So when Remy joins Ciara and Dale, the old two-person partnership legally dissolves, and a brand new three-person partnership is born. It's just about closing one legal chapter to start the next one. Of course, sometimes it does mean closing the business for good, and that specific process is called liquidation. Liquidation isn't chaos. It's actually a very methodical four-step process for winding down the business fairly, and the order here is absolutely critical. First, you sell off all the assets, the trucks, the tools, everything, and turn it into cash. Second, you calculate any profit or loss from that sale and split it among the partners. Third, and this is non-negotiable, you pay off all your outside debts. The creditors always get paid first. And only then, with whatever is left, do you do step 4. Distribute the final cash to the partners. Whew. Okay, we have covered a lot of ground here, right? From legal structures to accounting for bonuses and liquidation. But you know what? When you strip all of that away, the decision to form a partnership really boils down to something much more fundamental than any numbers on a spreadsheet. Because of things like unlimited liability and mutual agency, you are putting your complete and total financial faith in another person. So the ultimate question you have to ask yourself isn't about the business plan. It's this: who do you trust? Who do you trust enough to hand them the keys to your financial future? Because that's the real heart of a partnership.